This is the MBK Beat with Mark Kashevsky from MBK and Associates, Inc. Your place for finding all you need to know about life insurance and how you can get more out of your money. Recorded live here in Buffalo, New York, it's time for the MBK Beat with Mark Kashevsky. Hey folks, how we doing? My name's Jeremy, and this is Mark Kashevsky with MBK and Associates, Inc. And this is the 8th episode of the MBK Beat, where we talk about pretty much everything that you might not know about life insurance and retirement benefits and even executive benefits. And, you know, we dig into a lot of different creative strategies. Remember to subscribe via Apple Podcasts, Spotify. You can also watch the podcast and see our great outfits on YouTube. And essentially today we're doing something a little bit different, but this is going to be corporate-sponsored group life insurance. You can check out all the other episodes where we focus on sort of all different packages, but today we're going to be doing corporate group life insurance. So, Mark, obviously we know we're probably talking to someone in the corporate world, but who's the specific audience for today?
Specifically, we're targeting successful business owners, professionals, and high net worth individuals. That's our primary focus, and people that are looking to save income taxes and increase their after-tax retirement income.
And so this is for business owners. And does this reach out to all of the company, or is this more for the top, or is this for sort of everyone involved?
Well, the focus is really for the management group, either the ownership group, executives, or the professional staff, but based on non-discriminatory regulations in the tax code, you have to cover a broad group of people that will meet certain requirements in terms of service, full-time, part-time, etc. They all have to be considered as part of the plan. Okay.
So if nobody knew essentially anything about or had never heard anything about corporate-sponsored group life, what is it in just a basic definitive way?
Well, it's a permissible permanent life insurance funding strategy that allows businesses and professional organizations to shelter additional funds to create supplemental retirement income and do so on a very tax-efficient basis. And we'll get into that a little later.
So how does it work then? If do you have to be, this is probably not necessarily for, upstart or smaller businesses. Do you have to be a bigger business?
No, actually, the majority of the cases we work with are really smaller organizations, really under 25 employees or under. And there are a lot of closely held businesses and professional groups that meet that criteria. And number one. Number two, you have to be a C corporation, or you have to establish a C corporation to take advantage of this benefit. It's strictly limited to C corps or PLLCs that are taxed as corporations. And a PLLC is a professional corporation. That's number one. Number two, let's say you have 20 employees, and we develop a census and look at how many of these people are full-time, have they been here a minimum period of time, do they meet a certain age requirement. Out of that 20 group, they might have 12 or 13 people that qualify, including the owners and the professional staff.
Oh, no, that's okay. So how does this differ from sort of, what would someone need to know, or someone who needs this right now? Because obviously everyone sort of has something probably, but what does this provide for them that's gonna put them in a better position than they are today?
Well, this goes back to a basic problem that you have under qualified pension plans, that the highly compensated people, the owners, the professional staff, they're limited to what they can put away. I was just talking to an executive at a credit union recently and said, Mark, I had to take back $10,000 of money I put away because I exceeded what I can put away. And what he can put away and what the credit union is putting away for him is never going to really build up a substantial benefit relative to his salary. So the problem you have with most qualified plans, 401k plans typically, or profit-sharing plans, etc., is they limit what you can do for the top-paid people. Number one. The other issue is people are beginning to realize that taxes are going up. We're spending trillions of dollars and buying all these benefits. People, it has to be paid at some point. And everyone likes to talk about taxing the rich. Well, let me tell you, the rich is going to become a very broadly defined term at the end of the day. And when you start taking money out, this morning I had a long meeting with a client and his spouse, and they're looking to retire in the next 5 years, and they've done very well. And now they realize all this money they've accumulated, they're going to be paying tax on for the rest of their life, and they realize they're going to probably be paying more tax on the way out than taxes they saved on the way in. So people are looking for alternative strategies to mitigate those issues, and this corporate sponsor group life strategy is exactly what that's about. Now, once you're once you decide that I want to put some more money away and do it on a more tax efficient basis, and I'll talk about that in a minute. We have to identify a couple of things. One, are you a qualifying organization? Are you a C corp, or can we get you to a C corp? Two, show me your employee population. Who has to be included? Three, how much money would you like to put away? There is no specific limit on these plans. It's really defined in terms of overall compensation, which is a general rule in the tax code. But, if a client wants to put away, I've got 3 executives and we want to put away $50,000 each, fine, we can maybe do that. And that's number, we'll come up with a number we're targeting, and then we have to find out what the cost to cover the other covered employees are. Because under the regulations, you have to make this benefit permissible for everybody, and it has to be employer funded. Now, once we develop a census, figure out what the cost or budget is, we then will run calculations, which, because this is a corporate-sponsored group life insurance program, we're going to develop face amounts of life insurance as a multiple of salary. And everybody gets that multiple. And it's going to come up with a cost. Now, that cost may be $150 for the executive group. It may be X or Y. It could be $20,000, $50,000 for the balance of the employee group. And that whole cost is deductible to the corporation. And the employees that are covered have to pick up a portion of that benefit cost based on a formula in the regulations which is typically about half. So if they're going to fund a benefit for me that's going to provide another $50,000 of funding for retirement, I may have to pick up $25,000 on a 1099. Now think about that. That $25,000, I didn't get the money. If you get a bonus for $25,000, you have to earn $50,000. It's a cash bonus to pay the tax. So to put $50,000, if they were to bonus me $50,000, they'd have to pay me $100,000 to cover the tax to put $50 away.
To get that 50 to you and not lose to right. The IRS, essentially.
Now, under this plan, if my company puts away 50 and they deduct the whole thing, I have to declare $25,000 of non-cash income benefit. Basically, here's the value of the benefit. On a 1099, I'm only paying tax on this 1099 form, a piece of paper. That's a huge concept. So my tax, instead of being 50, is $12,500. That's pretty efficient. So that's the first, this is deductible to the corporation, and the participants are only paying tax on the taxable portion off of a tax form. They're not getting the money. Now, as far as the other employees that are covered, they would get a similar benefit as a multiple of their salary that's paid for by the employer, but they have to cover the tax. And typically we find a significant number of employees don't want to do that. They don't want to have to pay for anything. So that being the case, we will document that, and then they will get they'll at least get the death benefit. Everybody has to get something under the discrimination rules to do this. So we may have 13 people that are eligible, including the 3 owners. Of the 10 employees, 2 or 3 of them may want the benefit and are willing to pay the tax. The other 10 are not. That's a typical situation. So that this cost, the targeted money for the 3 executives may be $150,000, and then the cost to cover the remaining group may be $5,000, $10,000, whatever. It's manageable. Could be $20,000, but when you look at the tax leverage you're getting, you do the math and you figure, is this better than taking a bonus? And there's never been a case where it's, the decision is, no question, this is a good deal from a tax standpoint. So that's how we set it up. And these contracts are funded for 5 years, because after 5 years, when you do the tax calculations of what's reportable, it doesn't make sense anymore. So we'll fund these for 5 years. The executive, professional, employee, whoever's being funded under this plan, they own that contract, and it's theirs forever. It's fully vested from day one. And that money just sits there and grows in these high cash value contracts. And then at retirement, whenever they decide, not when the government decides, they can start taking non-taxable income for a minimum of 20 years, in many cases for life. Okay? So you're talking about non-taxable income for life. And that's pretty significant because, for example, the meeting I had this morning with this couple, they've done very well, and they're looking at, well, we're going to take 5% out of our investments and our pension plans and IRAs. Okay, and I said you're probably looking at 5%. Well, that number's taxable. Well, these contracts that we utilize, these are indexed universal life contracts, what I call current generation contracts. We're able to pay, based on the cash in the contract at 65, we're able to pay 8 to 10% of the cash out for life on a non-taxable basis. So I told this couple, the advantage of this is, number one, we can pay substantially more than the 5%, number one, 8 to 10% of the principal, and do it on a non-taxable basis for life because of the contractual provisions in the contract. So it's when I say it's tax efficient, deductible at the corporate level, only a portion of it's taxable on a 1099, significant tax leverage there, and all gross tax deferred. And at retirement, we can pay significant income streams that are non-taxable. And by the way, there's always going to be a death benefit. So that's really what the plan's all about.
And it's kind of, it's somewhat interesting to hear that the death benefit being sort of like the bottom line, and that's obviously why we've started this podcast, is to touch on the things that people may not know about life insurance and these packages, because traditionally, obviously, the death benefit is sort of the stigma that follows around, I think, life insurance, and it's not something that I've done a whole lot of thinking about at this portion of my life, but it's clear that, the education of these things, there's so much going on that you would need someone that has seen it all, essentially, someone like you. Is there anything that people would need to know as far as regulatory or reporting requirements?
Yeah, there's really, it's not that complicated. It's not anywhere near like a qualified pension plan or some other things business owners get into. But you do have to, somebody has to calculate the reportable income that has to go on their tax return, and somebody has to make sure for the 5 years you're funding that you're not in violation of any anti-discrimination regulations. And we bring to the table a third-party administrator that administers 100 of these plans, and for a nominal fee, they'll do that. It's not cost prohibitive at all. Taking
just a quick step back, as far as when you mentioned like sort of like that It seems kind of interesting to me, the fact that you could have sort of those two groups and sort of everyone can be included in the non-paid. Could you touch on that a little bit, like what the difference would look like for the employee as far as the people who would choose that almost higher tier where they pay the tax, and then the lower that said, like, I don't want it?
Well, every employee that is eligible gets three options. Do you want option one, where you're going to get the same benefit the boss is going to get, and he's going to pay for it, and you're going to have to pick up the tax? And that's going to be let's say I'm making $50,000, and the benefit's based on 2.5 times my income. Well, that's a $125,000 life insurance policy funded to the max to create retirement benefits, and that's going to cost $8,000 a year, and you're going to have to pick up tax on $4,000. Well, I don't want to pick up tax on $4,000. Okay, if you don't want option one, option two, you just get $125,000 of life insurance, and the tax is $50. Well, maybe I'll take that one.
I could see how someone would get stuck on that.
Yeah. Or I don't want to pay anything. Well, then you're going to get $50,000 of life insurance, period. And there's no cost to you at all. So every employee gets those three options, and the majority of them do not want to pay the tax. Some do, are willing to, and most of them are not. And so, once you go through an employee group, we'll figure out, okay, what's for the three principals, we're putting $50,000 away. It's $150, and for the employees, it's going to cost another, 10 or 15. From an employee benefit cost standpoint, if you're the business owner, that's a pretty good deal.
Yeah, absolutely.
Yeah.
And this may be a very dumb question, but when we talk about taking these non-taxable distributions, what are we talking about? Because again, if I'm the layman here, and forgive me if this is a dumb question, but in my future, I'm going to have to know these things too. So when we talk about taking money out, what are we saying? And you mentioned like the 5% versus the 8%. Am I taking that money out of what I had saved into these plans? Is that my money at 65?
Well, that's a very good question, and we could really go down the rabbit hole if we want to.
Oh, well, let's save that for another episode.
No, but I will say, I'll try not to get too far down the rabbit hole. But what happens when we're putting, and with the new tax laws that are coming, and trust me, a significant number of these proposals to increase taxes and eliminate deductions are going to happen under this administration, whether we like it or not. And we're going to have to live with this for at least 4 years. But taxes are going up, deductions are going down. Life insurance forever in the tax code has enjoyed a favored tax status. The buildup of the internal cash values are tax deferred. That's not being questioned. Distributions, if they're policy loans, and that's how we do it, we use policy loans to do this, they're not taxable. And those, whatever debt is incurred on the policy to do using this strategy is extinguished at death by the portion of the death benefit, so the loan goes away. So there's no tax ever on the distributions. And the death benefit, whether it's the gross death benefit or the net death benefit, is always income tax free. So here you have tax deferral, tax-free non-taxable distributions, and a tax-free death benefit. And on top of that, we're able to fund these under the tax code and get a deduction and only partial income to the employee. It's really it's a grand slam home run.
It kind of gives what strikes me is the options, and I think that would be good for any company that has a lot of different types of people, or even people that have a high rate of different, even maybe socioeconomic statuses within the company, where maybe someone can't afford it and they just want that sort of lower tier and don't want to take on that cost. That seems like it would be sort of all inclusive, and maybe that's where some of that non-discriminatory comes in, is it's got to have something for everyone.
Well, that's basically that's the intent.
Okay.
But you can't just wink and say we're not going to talk to the employees about this. You have to say, okay, these people meet the eligibility requirements. They got to be considered. Here are their numbers. here's the worst case scenario. If everyone took the option 1, here's the least costly if they take option 3. And, you're going to probably have a couple take option 2 and 1. Most of them take 1. You may have 1 or 2 employees that are willing to pay the tax. So, and in smaller groups, frankly, it's usually just the owners and the employees, the staff people are just taking the basic insurance. But everybody has to be given that chance, and our job is, go over that and not arm twist anybody, but give them an opportunity to make a decision based on the information.
Yeah. I was going to say, do you feel that what would make all of our episodes are sort of different options and different customizations are obviously available for different types of people, but generally across professionals, individuals, and even executives, what do you sort of see as maybe why people are afraid or sort of bashful to look into these things? What do you feel in your experiences would keep someone from making these sort of uncovering these stones in their own portfolio?
Well, I would challenge that comment to some extent. I don't think people are bashful anymore. I mean, there's a perception that life insurance only is for something when you die. And at the end of the day, we're paying a death benefit, no question about that. But the way the products have evolved in the life insurance industry, that's really changed because they're trying to, provide benefits when you're dead, when you're living. If you're disabled, you can get money out of the life insurance contract to cover long-term care expenses now. You have liquidity if you need money for an emergency on a favorable basis, not a draconian basis the way it used to be. So, they're trying to address various life issues as people go through life. And that's a game changer. And now that you have, the ability to make more than just 2 or 3% on a contract. I have a contract last year where my wife and I made 20%, almost 22% actually, on a cash value. I have a client that made over 100% on his cash value in one of these contracts because of which index he put it in, with no risk of losing money. I mean, that's 10 years. Nobody, 20 years ago, this was never impossible to talk about. So the products have really changed. And and people are asking, what can I do with my insurance? Number one. Number two, it's the message has started to get out. And thirdly, what's really driving this are taxes. And everybody realizes you don't live on rates of return, you live on income. And just this morning, someone says, we're looking at, this couple I talked to this morning, I know has more than $2-3 million saved up. And they're looking at 5%. So if they have $3 million at 5%, that's $150,000 a year. I mean, we worked our butt off our entire life to save all this money, pay our bills, pay tax on some of this money, and all we can take out is $150,000, and we're going to have to pay tax on it. That's like $75,000 a year. And I can guarantee you his lifestyle is not $75,000 a year. So, when I can tell someone that you could take $300,000 out a year on the same amount of money and never pay any tax on it without any risk of losing money, that to me is a game changer. That is a game changer. That's why I was late here this morning, because they wanted to know more about it.
And that's a good thing. We'd rather have you making those moves than doing these. But the benefit of these, obviously, is we get to talk about these things, and then when you're sort of out doing the things that you need to do, your prospective clients or maybe even your friends and family that may find someone. That's why we want to get this stuff down on record, because it seems like it could be so beneficial to someone. What sort of one big thing that people would need to know about the concept of working with sort of I don't want to use the wrong term, but an independent agent versus working with sort of like
they call them captive agents.
Okay, yeah. I figured there would be some sort of term.
You're going to sell any product you can, except it's going to be ours. Okay,
right.
That's a captive agent. No, we're an independent insurance brokerage firm, and not everyone's got a lock on the best product for that situation. Compensation. The interesting part is at the end of the day, we're compensated by the carriers, and that compensation is regulated by law. So, whether I'm dealing with company A or B, within a few percentage points, I'm going to get paid the same. So, we're in business to make money, but we're in business to solve problems and add value. Where can we add the most value for this particular situation? Now, for this type of strategy, there's only a couple carriers that have a product. But for something else, if someone's buying term insurance, that's a different story, or disability insurance, something else also. So you go where the best solution is for the particular problem or strategy you're trying to maximize. Okay, so that's how that works. But at the end of the day, our approach is basically meeting people on a favorable basis, getting to know them and develop some rapport, and then getting to a situation where we can look at their facts, identify what the goals are, what the problems are, put together some solutions or ideas that will help them, and then on a collaborative basis, get to a finish line, the most appropriate and timely solution for them, given the situation we're dealing with. So that's really how we do business. I think that's also important. Is that like you said, we're not captive to one company's product or one product, and two, our focus is, we're trying to get ourselves into the client's shoes as much as possible, knowing what we know. You know what you know, but you don't know what you don't know.
Right.
And our job is to understand their situation and how their head's screwed on, and how can we help them do a better job of what they're trying to do, knowing what we know that they don't know, okay? Mm-hmm. And being able to articulate that in a fashion that they can get it. I mean, my discussion this morning at breakfast with this couple was basically eyeball to eyeball. I mean, I shared 2 pages of information with them, and that was it, concepts. But everything was, is this making, is that your situation? We don't, taxes are a problem. We want to maximize retirement income. We don't want risk when we retire. Okay. Well, here's how this works. And, and people like this, typically they're smart and they need to be educated. And boy, I'll tell you, they asked very good questions, which is why, and they kept asking more questions. And we tried to, articulate what we're talking, the kind of stuff we're talking about today, but to do it in terms that aren't, legalese or insurances or...
Yeah, it's almost like everyone has a different money language in a sense, like wherever you came from or whoever you are, you have everyone's sort of individual in the way they look at it.
I'm trying to speak in the English language. Okay?
Yeah, right, right.
And, just make it, the common sense, I use metaphors. I don't try to use too many multi-syllabic words or catchphrases.
Yeah, I call it overspeak sometimes in the marketing industry.
Because, at the end of the day, if you don't, well, number one, I maintain, and this is probably my best closing remark, if people don't like you and you don't like them, you're not going to do business with them. Two, if you can't develop some type of a trust relationship where they feel you're above board and you think they're going to be, if you don't have that connection, you're not going to do business. I think clients need to know that we know what we're talking about in order to be able to demonstrate competence. And fourthly, we've got to be able to, have a conversation where we can size up the situation and know where the problems and opportunities are, and then be able to, take our knowledge and our solutions and put them into their situation and articulate in a fashion that they can understand that they get it, okay? And if so it's a process. And I think what we're really good about, I think we're very good about knowing what we do and wanting to help people, but I think we're also good at being able to, articulate things and plug them into their situation.
Yeah, translate almost.
Yeah. That's what we pride ourselves on. And we're not into a gazillion numbers and 50-page proposals and trying to impress people. We're trying to really help people.
At a human level, it seems sort of a trustworthy, truthful, insightful. I think that. Do you find that at any times, in your experience, have you found people sort of? I know you mentioned earlier that you would challenge the idea of people being afraid, but do you ever find that people, once they do take that good hard look, that does it affect them in a way that maybe they feel sort of defensive, or do you have to is it difficult to sort of tell someone what they don't know in a way sometimes?
We meet people either on referral or through introductions from other advisors or brokers, or sometimes on our own personal observation. And so, and we go through a kind of a vetting process on both sides to see if, we're going to go anywhere, kind of set the ground rules from a relationship standpoint. Mm-hmm. And once we get by that, and by the way, half the time we don't get past that. Mm-hmm. It may be because, we're not on the same page here. I don't know if I've got some issues. He may have some issues with me. Who knows what? There's not much I can do here. Mm-hmm. Whatever. We may not even get to a second meeting, but typically when we get to a second meeting, most of the people that drop out of the process with us, it's on the first meeting. Mm-hmm. After that, rarely, what typically will stop someone from doing business is their financial circumstance changed, or there's something else that is taking precedence. Mm-hmm. And so it's really more of a timing issue. Mm-hmm. So that once we get through the process, sometimes we may not get to the end point saying, yeah, this is the solution you should do. Occasionally when we get to that, when we're at that point, typically we're fully engaged, but either typically something else is taking precedent or something changed. For example, with COVID, right. I had a number of clients. Well, let me tell you, things changed overnight. Right. So I have 15 or 20 files sitting on the back burner right now, and some of them are coming back to the front burner. Mm-hmm. But that was a huge, obviously, event, and banking rules changed on a loan, or I'm getting sued. Right. My wife's divorcing me.
Yeah, you never know.
Let me tell you, all those things have happened in the process, and you just have to respect those issues. And you've got to. At the end of the day, we don't sell. The client has to buy. Mm-hmm. And our job is to do what I told you, to handhold them through a process, and then they ultimately, people typically act in their best interest. Mm-hmm. Okay. And so you have to trust that at the end of the day, because that's how you get things done and have long-term relationships.
Right. Well, if someone did want to kind of take a step and work with MBK and Associates, what do they got to do, and what should they expect the first step to look like?
Well, call us and let's meet. And let's go through the relationship dance, as I call it. Can we establish 3 or 4 of those issues up front? And if we can, then let's get some facts together and some information. If this is something you want to look at, that's how I left it with this couple this morning. I said, they had a couple issues. There's a timing on this. I said, well, we could do it one of 2 ways. I could model some numbers on 2 different scenarios, but think about what you want. Think about what we talked about today, and if you have a number, I'm happy to put some modeling together. We can look at that and develop some strategies, and then see how do we get to the finish line together, and that's the process.